Hello, everybody, and welcome to the session. Today is July 10, 2023. This is our Smart Tiger Live session. My name is Jose Blasco. I come here a couple of times a month thanks to Tiger Brokers. It's always a pleasure to join such a vibrant community, and we talk about options trading, which is the reason why we call this Tiger Live session Smart with double T. As you can read below, we do a special market analysis report for Tiger traders, and special, it's because we use options data to get to understand the markets better instead of simply looking at the candlesticks or the bars on a chart, which of course we also do, but we also add data coming from the options arena, which provides an edge in trading. Anyway, as we're getting ready to get started, you can see I am highlighting on the upper left side of the screen the financial, sorry for that, the financial disclaimer. So please read it carefully when you have a moment as we are launching the session. I'm counting on everyone to read it completely because it is indeed important information. As we all know, trading carries with it risk, and therefore you have to be well informed about the risk around trading. I would assume that some of you are new to trading. I would also assume that some of you are more experienced. So again, everybody's in a different place, but the risk is there for everyone. Okay, so please read it carefully. And also, as we are introducing the session, and I'm making a couple of extra minutes for people to join, I also wanted to mention the fact that I am here to help. I am watching you both on the YouTube channel as well as inside the Tiger Brokers app. So if you have any question and you type it on the chat box, I will see you. And as I see your questions, I will be able to interact with you. I will be able to provide answers. And therefore, I'm counting on you to be proactive, to be engaged, and work with me in the session. So instead of a monologue, we can have a little bit of a conversation. That would be truly ideal. So counting on you to do that. And as the session is now introduced, so let's begin with the agenda, which is going to be a little bit more of an introduction, just a little more. And then we'll look for options trades in the market. Today we're going to be trading calendar spreads, maybe a new strategy for you, maybe not, depending on what you have traded before. So we'll be looking at that. And then from there, we'll move into the smart market commentary. And I have a bonus for you, by the way, so I will be also sharing that during the session. And then, of course, Q&A. Instead of leaving it to the end, I think it's more dynamic if we do it as we go, okay? But again, that you choose that. You can type your questions anytime you like. Certainly, I'll be watching the chat box. And also, if you have no questions, but I do ask you a question, such as, are you with me? Is this concept clear? So I would certainly appreciate your feedback on the chat box. So that way, again, it's not a monologue, because my choice could be to be live here with you today, or I could just send a video that then is playback, isn't it? So since we are live, some of you may be watching this recorded, but for the ones of you being live, let's work on this together. Okay, guys? Great. Wonderful. So my name is Jose Blasco. I said it briefly at the beginning. What do I do? I am a trader. What do I trade? I trade everything: futures, options on futures, currencies, forex, you name it. All markets have pros and cons. And as a trader, my choice is to use multiple markets. So I can, depending on what I'm trying to do, let's say a long-term trade versus a short-term intraday opportunity, something like that. So depending on what I'm trying to do, I use the assets that provide the greatest level of convenience for me to manage my risk, to add odds in my favor. And that's how I trade. So I do diversify across assets, across strategies, and so on. Apart from that, I have a collection of passions in life. To be honest, I'm passionate about life in general. There are many things I love. One of them is spending these few minutes with you guys, doing some delivering some training, some coaching. I love to do this, and I'm definitely very much into that. Trading technology is another passion, and then of course I have a collection of personal passions which are not related to the session today. But anyway, trading is like life. Okay, so if you are passionate about life, odds are that you will be passionate about trading. By the way, talking about that, this passion I just mentioned, led me to write a book. This book is on forex trading, as you can see here on the upper left. But while this book is about forex trading, this book can help you no matter what you trade. Okay, no matter what you trade, this book will help you. Why? Because in the end, no matter what you trade, the asset you trade is priced in a currency, and therefore understanding trading from the point of view of currencies allows you to, number one, trade the currencies. Why not? Even though, let's face it, it's an over-the-counter market. It's I would say is less sophisticated than options, for example. But while now you know how to trade, you can also use that trading knowledge and apply that to other assets, because all assets you trade are priced in currencies in the end, isn't it? You trade an option, you buy a call, and you pay 200 what? $200. That's a currency, right? So yeah. So anyway, go take a look at our book. With the book comes a free course, access access to a series of tools as well. So you can go ahead and take a look. What else? TradeWithUFOs.com. This is our company. I am the founder of TradeWithUFOs.com. What are the UFOs? You will see me use the UFOs in just a moment. On the real-time charts, I'm going to move away from the slides in a couple of slides, and we'll look real-time charts. And basically, what those UFOs represent are on-field orders to either buy or sell. And with those on-field orders identified on the chart, certainly you can become much more precise when it comes to entries and exits. Or even with options, you can do your non-directional trades this way. Okay, so we will be talking about all of that. So options opportunities. Okay, we're going to be using different techniques, different schools of thought. As a company, as TRADDICTIV Trade with UFOs, we actually have our own trading platform. We also have technology that we could activate inside TradingView, which TradingView can be connected with Tiger Broker, so it's very convenient. But we also have our own trading platform called Top, which I will flash for a second, and then I'll come back to this in a moment and do the whole planning and of the trade here. So this is Top. Okay, so I'll come back to a moment in that. Top means TRADDICTIV Options Planner. And Options Planner means that our platform Top plans the options trades for you automatically. So especially when we are dealing with option spreads and things of that nature, which are a bit more complex, again, depending on the type of options trader you are, depending if you have studied options for a long time or not. So you may feel a bit overwhelmed, you may feel a bit confused. Maybe that's the case. Maybe you're just trying to save time and using technology like a GPS, if you wish, which way to go. For sure, our platform can help you very much. But in any case, let's go back to the slides for a moment, because I said I have a bonus for you. So here's the bonus. The bonus is called Auto Climate. This is a tool I will be using right now, and I will be using it inside Top. The one you have here is for TradingView, and in TradingView it looks like that. So this is TradingView, and you can see Auto Climate is here on the bottom part, okay? And this is basically telling you if it's time to be a buyer or a seller or what. So I'm going to show you how to use it in just a moment. And you will see. Okay, so if you want to use this, just use this QR code. Just scan the QR code, and then you will get to our website, tradewithufos.com/aclimate. And then what you do is that you input when you do the how do you call it, the checkout process. Okay, because there is a one-time fee, $8. So when you do the checkout process, you input the coupon code CLAIM8, and then those $8 become zero. So then it becomes free. And that's my gift to you, which beyond a gift is a fantastic trading tool that hopefully can help you very much. And I'm going to demonstrate how I use it myself. If that makes sense to you, you can also use it yourself. Okay, very nice, cool. Okay, so let's get into Top, and let's begin the planning process for our trade. So the trade that I am going to discuss today is a trade on the SPY ETF. So today, instead of trading a stock, I'm going to trade the index itself. Typically, when we do Tiger Live sessions together, what I do is that I find a trade or two with stocks, and then I go and I do the market analysis with the SPY. Okay? Well, today, if that's okay, I'm going to reverse it. Okay? Today, if that's okay, I will reverse it. I will do what comes on the slides after, which is to do our special market analysis for Tiger traders. I'm going to do that now, and then I'll do the trade, because the trade I'm going to do is on the market itself. So I guess from a sequence point of view, it makes sense that I complete our market analysis before I do the trade in this particular case. Good. So to do our market analysis of the SPY ETF, which represents the S&P 500 index, SPY. What I'm going to do is a daily time frame of such market on the left, and look who is here. We got our friend AutoClimate right here. So what is AutoClimate suggesting at this moment in time? And if I zoom in right here, we can see that we have a blue dot, which is tick. This, technically speaking, means that you're in an up climate and you are willing to be a buyer. But notice how we have this gray line right below the dot. And that gray line means change of climate. So notice every time there is a gray line, then there is a change of climate. Gray line, change of climate, gray line, change of climate, gray line, change of climate. You see that? So in other words, we are in a situation where as the market opens, we're going to have a red dot on the screen. So we're going to be in a down climate, and therefore statistics suggest, based on AutoClimate, statistics suggest that trading to the downside carries with it a greater probability in our favor than trading long. So I want to position myself to go short. Okay, that's what I want to do in the market. Now, that doesn't mean that I expect the market to go to zero. No. What am I expecting if I go short? Well, if I go short, I am expecting, and this is the beauty of AutoClimate, okay, I mean, the great applications of AutoClimate, but one of the very interesting things is that we have statistics related to count. And because it's going to be a down market, the only statistic I care about is the one in red color, which is 3. 3, which is a 1 standard deviation calculation, represents what tends to happen in 68% of the cases when the market starts defining itself as a down climate, which is going to happen as the market opens because we have this little gray line below the blue dot. So as the market opens, we're going to have a red dot. So how many dots do we expect before it changes to blue? Well, 3 red dots, meaning 3 down days. It's a normal thing to happen. I am oversimplifying the language of formal probabilities and statistics, and I'm calling 1 standard deviation a normal thing to happen, a common thing to happen. I think that is expected, right? So what is expected? What's expected is a move to the downside by 3. Now, does this happen all the time? No, of course not. 68% of the times. So notice how there are times where it's 2, there are times where it's 1, there are times where it's 3, and there are many more cases on the left, which, if you're curious, as you download your own AutoClimate, so you can go and take a look. But we are in a situation here where we expect the market to start moving down. Okay, good. Start moving down for 3 days and then potentially go back up to generate blue climates to the upside. Now, how positive I am that this climate is not going to be like the end of the world on the way down. Okay, are we going to see just 3 days down, or is it going to be 3 years going down? How positive am I about that? Well, apart from the statistics that come from AutoClimate, which, to be honest, it's a very good reference point, isn't it? The other thing that is very interesting, so notice how I have this volatility comparison where I compare the implied volatility of the calls versus the implied volatility of the puts. It's actually a 3-day average of the implied volatility of the calls and the puts. And notice how I have the blue line above the gray at this moment in time being the blue line, the implied volatility for the calls, and being the gray line, the implied volatility for the puts. Now, notice that on that date, we had the opposite. The gray line went above. Okay, so what happened on that date? Well, if I look up what happened on that date, what's interesting, sellers were coming on board. The gray line above the blue means that in the options arena you got sellers. So sellers were coming on board, but look, the market kept going. And that was really against all probabilities because the climate was already very much extended and the climate kept going and going. That's really uncommon, but it happened. Okay, which again, this is the importance of probabilities to be understood. That is not a guarantee, even though it's a great reference. Okay, but what happened on that other date? Well, on that other date, what happens is that the sellers were gone, buyers are back, and next thing you know, yes, we did have a little bit more. I mean, and probably the reason is because this blue climate was so extended. Normal thing to happen is 5, and it took like 15 or 20 days nonstop. So that was so extended that in the end, even though buyers were on board, those buyers were probably taking profit. But the moment that was over, very powerful move to the upside. Again, full climate propagation, which now is reaching its end, going to red. So where are we at? Well, we're in a market situation where the expectation is a movement to the downside before a continuation. Why am I expecting a continuation? Because the blue line is above the gray, the blue line being the implied volatility of the calls, meaning the buyers, the bullish traders in the options markets, because for the implied volatility of the calls to be above the implied volatility of the puts, one of those two things needs to happen, or two at the same time. One is more people are buying calls than buying puts, or more people are selling puts than selling calls, or both. They are buying more calls than puts and they're selling more puts than calls. In both cases, selling puts or buying calls is bullish. So that's how you get the blue line above the gray. And bullish means you got buyers in the market, buyers that are not represented on the price charts in the market, but buyers that we identify being there in the marketplace because we look at the options data. So we got buyers in the market, therefore we are about to get in a normal thing to happen. It's going to be three dots going down, but very likely at some point it will turn and come back higher and continue, and probably it's going to be a powerful wave after some retracement to the upside with this continuation of this uptrend. That's what market data is suggesting is going to be. So with all of that market data, I sound a bit more bullish than bearish, isn't it? But at the same time, there is a short-term opportunity for a few days, maybe three, okay, to get into a trade that could pay us on the way down. Now, I can do that in many, many ways. I want to set up a trade. Okay, and now I'm getting into the trade. Okay, so we've just completed our market analysis. Now we understand the market environment of the S&P. So now I want to get into a specific type of trade. And for that specific type of trade, I have many ways to go around it, right? So that's the beauty of options. Options give you options, right? So how can you get bearish? Well, you can buy a put. You can do a short synthetic or a synthetic short. You can do a bear put spread, or you can do a bear call spread, or you can do a bear butterfly, or you can do a bear ratio spread, or there are so many ways on how to address it. But I'm not going to do any of that. Okay, very nice to see you guys. Very nice to see all those comments on the chat box. Carrie, thank you for that. So there are many ways to go around, being bearish and profiting from a move to the downside. In this case, the beauty of options is that it allows you to kind of customize your definition of bearishness. And my definition of bearishness, based on the market analysis I just performed, is that I am bearish short term, and I am bearish mildly. I am not like a super bear expecting the world to end. I'm just expecting 3 days on the way down, and from there, continuation to the upside. Okay? So with that, I want to use an option strategy that makes me money if I'm right and the market falls. But if the market rallies, it allows me to, number one, lose very little, which that's obviously, if you're wrong on the trade, you lose. That's it. So if wrong, I want to make sure that the amount of lose is super tiny, because again, there is a bullish component in this market context. We just saw the blue line above the gray, right? So there are buyers in the market, so I don't want to be all the way bearish. Therefore, I want to make sure that if I'm wrong, I'm going to lose very tiny. And even more important than that, I want to have tools that allow me to massage my options play to give it a second chance to profit from me, or to reduce the pain if I'm wrong. Right? So if, let's say, you short a stock or you short futures, if you're wrong and you get stopped out, whatever you lost is what you lost, and that's it. What I want to do with options is not that. I want to put myself in a position where if I'm right and the market falls, I'm going to profit. But if I'm wrong, I want to give myself the opportunity to do something to the options play. I'm going to document that on the screen, no worries. Do something to the options play where now, if the $100 for me, next thing you know, I exit the trade for $30 of loss. I massage the trade, not $100, but I lost less than I was expected to lose at the beginning. And the reason why I want to have this approach is, again, because I'm bearish for very short term only, and there is a bullish component in the market. I would not be surprised that something like that happens, where you only have one red dot and then it goes back to blue, and maybe it teases you a bit and then I get back to blue for all the way. And if that was the case, so the market is going down, and now I feel, oh yes, I'm making money. Now it's going back up. Oh my God, I'm not. I'm back to where I was. Now I'm making a little bit of money, and then I'm slapped on the face. So if all of these are going to happen, all of this is going to happen. I want to have tools where within this process I can put myself in a position where I'm going to lose like so little compared to what I was expected to lose, or even maybe give the trade a second chance and profit in the opposite direction. Okay, this is what I want to do with this particular trade. Okay, Sutter, very good to see you, and Kerry, yeah, very very happy to take a look at Tesla in a moment. Okay, I will complete this trade first, and then I'll take a look at Tesla. Thank you for that suggestion. I love that. So let me load my sticky notes so I can document what I am about to do on the screen. So we are gonna do a calendar spread. So I'm just gonna bring this to the screen, and from there we're gonna start adding some information here and document this in a proper way. Okay, so we're talking about SPY. There are no earnings in the case of SPY. We are talking about using expiration dates, which are gonna be July something and July something. Why? Because we are in July, and I'm just betting for a trade which is going to be typically just a few days, if I'm right. So I don't want to use anything beyond that. And because I'm bearish, okay, this trade will not use calls. This trade will actually use puts. Okay, so I'm going to have to define which put to use. Okay. And then I need to give you information about that. And then we will need to talk about massaging the trade. Okay, massaging the trade if wrong. Okay? What can we do if we are wrong? Cool. So that's the plan. Okay, so I'm just gonna put my note here. Now, when looking at the chart, okay, so we see the market is falling here. I'm using our technology here, auto UFOs. We have buy on field orders at this price point, 433.46. So again, if we expect the market to go down, so first it's gonna have to hit that red UFO, may go back up, then goes back down, whatever, and then 3 days later we are somewhere here. Okay, so I guess that you are with me on my expectation of where we're going in 3 days. 433, we got buy on field orders there, and therefore my play is going to be all around 433. So I don't need to go crazy and get all confused by looking up and down the option chain. Which strike do I select? Blah, blah, blah. Simple. I'm just going to go ahead and look at my UFOs. 433 is the one I want to deal with, and therefore, even though I have not explained the expiration date yet, my trade is going to have me use the 433 strike. So this is a calendar spread. A calendar spread is made of buying a put and selling a put of the same strike, but we are going to be using two different expiration dates. It's not going to be the same expiration date. So let's take a look at the option chain for SPY. Let's look at dates, okay? And I'm just gonna delete everything when it comes to dates. And look, the monthly expiration date, which is the most liquid of the month of every month, is July 21st. Okay, is it 20 or 21st? I believe it's 21st, right? Let me double check that for a moment. I got confused. Yeah, 21st. And so this is the most liquid one. So when between now and that, the next Friday, if you wish, is July 14th. So I want to structure this trade using two expiration dates, one which is 11 days from now, one is 4 days from now. 4 days is quite close to 3 days. 11 days is the next expiration, which is 1 week after. And I'm just shooting for 1 week just because it's the most liquid strikes, and also because I'm doing this session for demonstration purposes, isn't it? So in that sense, with the majority of the stocks, those are going to be your best trades in the sense that Not all stocks have the same liquidity as the SPY. With the SPY, to be honest, is so liquid you can use 2 days to go, 3 days to go. It's so liquid. No matter the expiration date, is liquid. But other stocks is not the case. So using the monthly expiration date, which in this case is July 2021, which is the third Friday of the month, this typically helps the trade to work better. Okay. Good to see you. Yes, very nice to see you. Thank you for those flowers. Very nice. Yeah, so I'm gonna buy the 433 put that expires in July 21st, and I am going to sell the 433 put that expires in July 14. Let me simulate that so you understand what that does to us. Okay, so I'm just gonna go ahead and ignore all the strikes, and I'm just gonna focus on 3. Now, if I buy the 433 put, sell the 433 puts using July 14 expiration date, I come up with this spread, which is a put calendar. Okay? Using July 21st, buy the 433 using July 14 33 put. This trade would cost me $90, and it's a debit. It would cost me $90 and it's a debit, even though it has positive theta, meaning that you're going to make money on time decay like a credit spread. This is one of my defenses in case I'm wrong and that stock moves in the opposite direction. Okay, this is one of my defenses. Remember earlier when I told you about the market condition and why I'm not 100% bearish. I am bearish, but not 100%, right? Good. So $90 is what I'm going to pay, and therefore the most I can lose is 90. And we have the positive theta in here. Okay, now, so let me simulate this in a more visual manner. I'm just going to push this to a projection tool. So for the ones of you who have never traded calendars before, this will be understood. And here, I want you to focus on the upper part, which is the P&L of the trade. And I also want you to focus on the middle part, which is the stock chart. Okay, so this is the S&P. These are the candlesticks. So what happened, and this, by the way, this is, if I go all the way here, this is July 14. So what happens from now to July 14? Well, what happens is that if the market stays where it is and it doesn't move, I'm going to make $29.94. Okay, that's the time decay. So in other words, the market hasn't moved, it has not dropped, but I'm making money. So this is one way to illustrate the fact that while I'm bearish, and remember I told you I'm not super bearish and I want to have a little bit of a defense on the way up. Well, one way to think of defense on the way up is that the stock doesn't fall, stays the same. Guess what? I'm making money. That's good. Now, what if that stock falls? Well, if the stock starts falling, okay, so I'm gonna make more money. Okay, and especially if we reach the expiration date. Actually, let me go back. I said my target was 433, right? So 433, I went too low actually. 433 is more like here. Okay, so here we go. So let's say the stock did something like that, went down, then retraced a little bit, then finally went down, and this is the expiration date. So this trade is gonna make $212. So you are risking 90. That's the most you can lose. Okay, that's the most you can lose, 90. But if the stock moves your way, and reaches your target 433, something like that, on July 14, which is next Friday expiration, you will make $200. So it's like a 2-to-1 trade, not bad. It's okay. Okay, so hopefully this helps you to understand how these trades behave, but there is more to it. Okay, so let me document things properly. So if you guys want to put that in a demo account, for example, and practice it so you learn about this type of trades, so that could be useful to you. Okay, so if you get to 433, get out. Okay, entry, it could be during red climate. Okay, so I just need to make sure that in auto climate, which I will, and the moment I have the red climate, I could get in, and the moment it falls, this should be less, more. The moment it falls, um, looking at the chat box just in case there are questions. Okay, great. Thank you for that. So now, what do I do? And the maximum risk is 90. Okay, if you do the trade at the current price, the maximum risk is 90. So if wrong, you lose 90. If right and it goes according to plan, you make 212. Now, what if it goes against you? Well, the most you can lose is 90, but notice that one leg of the trade will expire on July 14, where the other one will stay alive until July 21st. So what can you do if on July 14 you have not reached 433? Okay, well, you can sell a new July 24 put against, let me document that, the 433 put you already own. Sorry about the fat fingers. Okay. So you can sell a new July 21 put. Okay, I would suggest to do the 432. Okay, against the put that you already own. And that way, what happens? I mean, I cannot predict what the price of the 432 put will be. Let's say next Monday, right? I cannot predict that. Next Monday will be July 17, if I'm not mistaken. 14, 15, yes, 17. So I cannot predict the price because it's including where is SPY, right? But I guess you are with me that this put will have some value. So let's say that put have some value. Let's say it has $20 of value, 20 cents. So what can you do next Monday if you didn't reach your target and made your $212? Then you sell the 432 put. Let's say you collect $20 for that put. So now what is your new risk? Your new risk has been diminished from 90 to 70. And guess what? If that market now falls to your target next week, which is very late, you expected the climate to propagate in 3 days, let's say it took a week and a half to go, well, guess what? You will still make your profit. Okay, you will still make a profit on the trade, which is exactly what I told you. I'm giving the trade a second chance while I am reducing the risk of the trade in case the market did not behave as expected. Okay, so yeah, so this is the trade, my friends. I will delete minus 20 because again I don't know the value of the 432 put. Maybe the 432 put is trading at $90, and then you sell a put against the put you own, and you actually are risk free. So you never know how much that put will be trading at, but definitely more than one. Therefore, your total risk after 1 week will be less than 90, even though you start the trade with a risk of 90. After you massage the trade next week on Monday 17, now your risk is less. Now, if instead of massaging the trade on Monday 17, you reach your target before the end of this week, congratulations, we were right on the trade and you made $200+ and you're a happy trader, and you go find a new trade, you close it and you find a new trade. No need to wait for next week because you got to your target. That's what you wanted. Cool. So hopefully this made sense. If you have any question, let me know. We are about to conclude the session as well, but I remember the question about Tesla. So I will take a look at that question right now. In the meantime, I will be checking the chat box, and if you still have a trade on SPY, I will obviously be delighted to get back to you with an answer before we complete the session. So questions, go for it, my friends. So Tesla, what's happening with Tesla? So I am loading Tesla here, and what do we have with Tesla? So first of all, I will expand. Well, with Tesla, we have a very similar situation compared to the S&P itself. This market had an Elliott wave turning point here, and we have reached the target of that Elliott wave turning point. So now the expectation would be some sort of a retracement. Tesla may be a bit more resistant to retrace, and maybe more something like that before it goes down. Why? because currently we are in a blue climate, which is confirmed. We don't have the gray tail below. Let me move my mouse so you see it. There is not a gray tail below. There is a gray tail on the S&P, but not Tesla. And the statistical duration of such climate is 8, where we've been in this climate for 6 bars. 6. In other words, a normal thing to happen, a common thing to happen, and my expectation would be for this to continue for another 2 bars. That's why I said I would expect something like that in the next 2 bars instead of beginning the fall. Okay, but probably after the S&P has been dropping for a day or two, probably Tesla will follow. And if Tesla does follow on the way down, so then the expectation is more severe. The expectation is 6 candles on the way down. Now, I would say nothing to be concerned about, really. On the options market, we can clearly see how buyers are there. The blue line is above the gray. So if Tesla falls, an expectation, it's a normal thing to happen. It's not something to be concerned about. It's just statistically possible. It's statistically normal. It's the statistical expectation, okay? So not an issue. Now, from an on-field borders point of view, so let's load the UFOs on Tesla. Carry. So we are looking at the UFOs on Tesla, and I'm going to look at the daily time frame, see where we're at. Yeah, so we have on-field orders at 265, 264 something. So this is where we are. So Tesla is really in the middle of nowhere right now. So the expectation would be it may take 6 days to get to 265, right? A couple of days of doing nothing, 6 days to get to 265, and from there, a move all the way to 300. It's indeed possible before the next retracement. So, yeah, depending on your trading methodologies, you may sell puts, you may do a bull call, whatever. But again, there are many ways on how to play this. But this would be my technical view of what Tesla is likely going to do from a price movement point of view, given the climate, given the options data where buyers are in the market, and given the UFOs where we can see where the buyers are sitting at, which in this case is around 265. Very good, everybody. Real pleasure, as always, to join you and be part of what you guys do. I will see you in the next Tiger Live session, which is later in the month. I believe is the third Thursday of the month, if I'm not mistaken. But also, if you are keen to stick around, you will see me again at 8:30 local time in Singapore, since I will be doing our market commentary, what we call our 3D market commentary, which we do every Monday to prepare for the week ahead. So I will be looking at 5 markets, which is S&P futures, crude oil futures, dollar futures, Bitcoin futures. So I will be looking at those 5 very relevant markets to look at the overall condition across, beyond looking at the S&P and doing an options play here on the S&P. So if you want to join me, just find me on the Tiger Broker app in 20 minutes time, and I will see you there again. And if not, I will see you in the next Tiger Live session. Take care, everybody. Thanks for joining. Thanks for the questions, the comments, the nice comments as well. And see you in the next one. Bye.